Okay, so here we are, the main market event. So the things we're going to be covering today, we're going to first topics the economy, what the economy is cooking, monetary policy, and the Fed. We're going to talk about fixed income, equities, the different equity sectors, international investing, and asset allocation. The theme that Larry Adams used, as we can see, is WWE. That's why it's called the main event. I'll be honest, I'm not a WWE fan, but we're going to go along with it a little bit as we talk about each of the topics that we just went through. Okay, so the US economy, what we're going to start with. The US economy remains rock solid. Okay, so one of the things that I've said a lot of times is that consumers are one of the backbone of the economy and consumer spending continues to grow. It's actually on the way up, you can see from this slide. And also restaurant bookings are solid, which is good news. So consumer spending remains healthy, supported by rising incomes and a solid labor market. So a strong part of the economy. The other part of the economy besides the consumer is business spending. So let's take a look at businesses. ISM indexes are improving. So the manufacturing indexes and service indexes are improving a lot. And CapEx spending is actually at the highest level ever. That's basically your businesses that are saying, we want to invest in ourselves and grow our companies. So basically, it looks like the picture of a very healthy economy. Now let's look at the labor market. The labor market is picking up, especially relative to last year. So last year, in average, we added 10,000 jobs a month to the economy. And this year, average year to date, we've added 92,000 jobs a month to the economy. We think that's going to settle somewhere around 70,000, but still a strong acceleration from last year. So what is some of the concerns on the labor market? Well, one of the concerns of the labor market is that AI will replace jobs. So let's just take a look at AI and 3 reasons why we think AI won't defeat human jobs. So AI replaces tasks, not people. And most jobs that involve many responsibilities still require human judgment. So for example, in our industry, we use AI to help us gather information, analyze information, but still nothing beats eyes on paper, empathy, people to people relationships. So AI will enhance, but not replace jobs. The other one is skilled labor still matters. Jobs that require leadership, creativity, empathy, and relationships remain hard to automate. So think of doctors, nurses, even plumbers, and the shortage of some of these skilled labor people that are in the market. And then the last one is that actually, as new technology comes around, new technology will actually help create new jobs rather than take away jobs. Innovation has historically generated more opportunities than it has eliminated. Okay, so what is a concern? Inflation. So one of the things that I say is inflation and taxes are like the 2 little devils on your shoulder. We always need to be aware of them. And if I were to describe inflation, I describe it as the Mack truck on the freeway that's piling up behind you, and you've got to stay ahead or get run over. So inflation has been heating up a little bit, and actually for the last 6 years has been above the Fed's target level of 2%. It's peaked a little bit more recently again with oil prices going higher. We think by year end, it'll start moderating to 3.6% and possibly by the year end of next year, get back down to the target of 2.2%. Supply chain risks haven't, what's keeping inflation standing? Oil prices, supply chain disruptions are still there. There's also AI-driven inflation, and this is what we call chipflation. So many things run on chips, and there's only so many companies that make chips. And so there's a chip shortage. When there's a shortage, prices go up. And when those chips go into things that we buy, then inflation, those things are more expensive. Also, services are still experiencing some sticky inflation. So things that can bring inflation down is oil prices moving lower, and we do see that happening, improving supply dynamics, and AI-driven productivity. So inflation has still been kind of the biggest threat to the economy. All right, so let's look about our growth forecast and the Fed forecast. So GDP, we have our estimates above potential. So if you guys have listened to these market outlooks for many, many years that I've done, we had what we called a plow horse economy not long ago. 1.5%, 2% GDP, nothing too high, nothing to write home about, but steady. And actually now you can see in 2025 and even estimates in 2026, we're looking at above 2% growth trend. Unemployment also remains very low at historical lows. So low unemployment, higher GDP growth means a very strong economic and Fed funds forecast outlook. That's our year-end unemployment rate. Okay, so let's look at the Fed and monetary policy. So remember, the Fed has two dictates, really. They want to maximize employment and maintain price stability, which means take care of inflation. We also had a change in leadership. We've had a new chair, and a new chair tends to generate headlines. And there's actually quite a few headlines even just recently in the last couple of days. So let's take a look at the new Fed chair, Chair Walsh's, what he is looking to do. Okay. So what the Fed chairman can do alone and what the Fed chairman cannot do alone is on this slide here. So what he can do is he can decline to submit his own projections. He can say, I don't want to say what my thoughts are. What he does do is he sets the agenda and the focus on internal Fed discussion. So he's the leader of the group. Remember, though, that the leader of the group is 12 voting members. So it's only one person as the Fed chair, and then the other ones are 12 voting members, 5 Reserve Bank presidents, 6 other board governors. He can launch reviews of communications and data frameworks. So those are the things he can do alone. What he needs the committee to do, though, is to set or change monetary policy in the Fed funds rate. So the most important thing to remember here is one man alone cannot change the Fed funds rate. They need consensus. He cannot change, reduce, or eliminate the dot plot, okay? And he cannot stop other Fed officials from speaking or expressing their own views. So the Fed chairman really has the power of persuasion is where his power lies at, okay? So the Fed is going to be under Chairman Warsh, the Fed is going to be looking at a few things. He's created a task force to review 5 things: Fed communications, balance sheet policy, data sources and methodology, productivity and jobs, and inflation framework. So what does that mean? First, communications. That is probably the most important one, and that is what we actually just saw the other day. The group is rethinking how the Fed delivers its messages, okay? Under Chairman Powell, the Fed was very vocal about what their forward-thinking projections were. They would state, we think at the next one, we're going to keep rates steady. They would put out there to calm the markets as what they thought they would do. But the thinking with that is that if the economy changed between now and the next Fed meeting, then they were boxing them in and not being able to be as nimble. So Chairman Warsh is saying, we don't want to be giving these big broadcasts of what we think we're going to do. We want to just see what the economy is, and then at that point, make that decision. And I'm going to bring this chart up over here on the right. Basically what this chart, it looks hairy and scary, but basically what this chart is showing you is the gray lines are the guesses, the market-based future expectations. Based on what the Fed says, this is what the market thought that the Fed was going to do. And you can see in that circle that's kind of gold, the consensus, the people, the markets kept thinking that the Fed was going to raise rates. And from 2010 to 2015, if you remember that period, you couldn't get a CD to save your life. And the Fed just kept rates down at the bottom, at the bottom, at the bottom, and never increased them. Vice versa, when we had that high inflation, consensus was saying that the Fed's going to cut rates, and actually they kept raising rates. So Chairman Warsh is saying half the time it's wrong anyway, so why are we trying to communicate what's going on? However, the markets did not like this lack of communication just the other day, and so the markets reacted, at least the bond markets reacted pretty strongly. Okay, so that's one of the major things that Chairman Warsh is trying to change. He's also looking at the balance sheet policy, which basically says what the right level of reserves should be for the Fed. He's also, and I'm going to just skip down to the last one, looking at the inflation framework. And this is taking a step back and reassessing how the Fed defines and targets inflation. So in the last slide I showed you, it said that the Fed's target rate was 2%. And it showed you also how over 6 years, we've not been close to the Fed's target rate of 2%. So what the Fed wants to do is try to reevaluate, is this 2% mark even reasonable anymore? And the way I liken it to is, let's imagine you were 25 years old and you had this perfect weight of whatever it was, and now you're 60 years old. Is that still your target weight, or do you have a new target weight? And so that's what the Fed is doing, is like, yeah, 2% might have worked in, the 80s, but maybe we need to readjust things. Okay. Not saying it's right or wrong, that's just saying what they're doing. So this combination in general of strong growth, stable unemployment, but we still have elevated inflation, leaves the Fed with little urgency to act. So therefore, we think that the Fed, again, with our guess, we think the Fed will remain on hold for the rest of the year. I'm going to skip that slide. That's not as important. Okay. So now let's talk about some fixed income. Bonds are back. I've said that a couple of times now. Bonds are back. And the reason why I say bonds are back is because not long ago, and we just saw that chart, interest rates were so low that bonds didn't make sense, for at least for the income. They made sense maybe for the diversification from equities, but not for the income matters. So bonds are back. Yield is now the name of the game. So let's take a look at yield. So again, look at where rates were the longest time below 1%. 1% on I think that was the 2-year treasury yield. And now we're back into the 4.5% range. Okay. So for the last 20 years, the 2-year treasury yield was below 1% for nearly half the time and at historically low levels. And in fact, from 2009 to 2020, on this chart, we can see bond yields often sat below the dividend yield of the equity market. So what the chart on the right is showing you is that basically you could get an equity that was paying a 2% dividend and had the potential for growth and price appreciation, or you could get a bond that was paying 2% that really would not appreciate over time. And so it didn't really make much more sense to have, from an income perspective, to buy the bond. From a diversification perspective, yes, but that's why in people's portfolios, we had bonds very low during this time and were overemphasized dividends. But now you can see that it's actually changed and it's one of the widest gaps ever. Your 2-year treasury, your bond ag yield is now under 2%, and then your dividend yield, or I'm sorry, the opposite. The dividend yield is now under 2%, and your bond ag yield is actually, like I said, 4 to 4.5 to even 5%. So it's a gap of almost over 3%. So that is important. That means that bonds are back, especially for the yield play. What else do bonds do? Bonds help stabilize portfolios. So right now they're offering higher yields, steady income, and they can also offset some market volatility. If we look at higher yields, also generally correspond to better returns going forward. So if we're in the 4 to 5% range, which is what we are right now, and that's that dotted box line, forward-looking returns on the bond market is somewhere between 5 and 6%, 5.6%. So bonds are looking very attractive right now for a very relatively safe asset class. Okay. Then we're going to look at this next chart here. You no longer have the need to reach for yield. So I'm going to show you this. So if we can get investment grade yields at 5%, and we go back to 2021, 2020, 2021, you can see that the only way that we were getting 5% yields was in very risky, high yield bonds, and almost double the risk in a high yield bond than in an investment grade bond. So it's very nice that we no longer need to reach for yield. The other thing that I'll point out on this chart is that light blue line now is only a couple percent points above the 5%. So you can get investment grade at 5%, or you can get double the risk for maybe 6.5%. So the risk reward ratio on high yield bonds is not there right now. We really want to stay in the investment grade world. So higher yields mean overall better forward returns. We're getting good steady income. We're also hopefully offsetting any market volatility. And that's what this last slide shows, is that on average, when the equity markets have dropped more than 10%, bonds have remained stable at a positive over 2%. So bonds do play a very important part of the portfolio. Okay. So the prescription for bonds going forward, higher rates, bodes well for future bond returns. So our base case, 60% probability, says that the 10-year yield will remain somewhere between 4.25% to 4.5%. Okay. And this is what I just said already, that the most attractive we think are the high grade, which is your treasuries, your US investment grade, and your municipal bonds. Always love a municipal bond. And you'll see the high yield, your risk reward ratio is just not there. Okay. So now look at high quality credit that remains attractive. That's what I've just said. And bond issuance. So this is an important thing too. I've just said bonds are back. Bonds provide all these benefits. Is there bonds to buy? And in 2026, our estimates are, we have actual and then estimates. Our estimates are that we will have record amounts of corporate issuance. So companies are issuing bonds. They're getting loans to invest in themselves and grow. So the highest level that we've seen since 2019. Why? Solid economic growth, positive technical backdrops, fundamentals reign supportive, strong corporate profitability, healthy balance sheets, all allowing companies to issue debt. And the main thing that I like about what's going on now is you have to have a buyer to have a seller. So with all these companies issuing debt, one of the questions is there somebody there to buy that debt? And one of the questions I've sometimes gotten from clients is, Danielle, is the rest of the world still buying US debt? And the answer is, surprisingly to some people, yes. In very high numbers, they are. In fact, there are 3 buyers still to every 1 bond issuance out there looking to buy these debt products, mainly because of all the reasons that I just told you about. Okay. So issuance is now 30% above last year's pace, putting 2026 on track to rival record issuance. Okay. And I'm going to skip that one. This chart, this chart is showing is leverage of companies, because then that's the other question people have is, well, if all these companies are issuing all this debt, are they over levered? Just like as a consumer over credit carded out, and so this shows the different sectors and their debt leverage. And you'll see actually technology, which is a big part of the issuance this year, still has some of the lowest debt leverage. So they're not over levered. All right, now let's get to the big boys, equities. Okay, again, I'm not a real big WWE, but they compare between wrestling champs and the equity market. Strength and resilience are key characteristics of the equity market. We've had now roughly 14 consecutive quarters of double-digit earnings growth, including 20% growth in each of the remaining quarters estimated this year. Very strong earnings growth, okay? And so earnings are the magnet that draws stock prices higher. So earnings are the backdrop. Prices can jump ahead of earnings, but earnings need to keep up to match those, okay? And earnings are getting revised, and they're getting revised higher. Normally, companies will put out, here's our estimates of earnings, and then as you get closer, they go, oh yeah, we were guessing too high, and we revised them lower. And actually, that's not the case. Earnings are actually being put out there and getting revised higher. So 2026 earnings have already been revised over 10% higher. Typically, they're only revised maybe 2% higher, right? I'm going to skip some of this. I wanted to touch on this too, the midterm elections on this right-hand side. So what this shows is performance after the midterm elections. And generally in a midterm year, in the late summer and the early fall leading up to the election, we do see a little bit more market volatility going on. There's a lot more mudslinging that's going on. There's a lot of news, some of it real, some of it not. There's a lot of stuff going on. But after the elections, no matter what the outcome is, if it's a full Democrat, if it's a full Republican, or if it's a mixed Congress where there might be some gridlock, generally 12 months after midterm elections, markets are up very strong, over double digits, over 15% on average. So again, the outcome of the election might be important to you personally, but it's not as important to the markets overall, just that now we've moved from that period of uncertainty to certainty. And the middle chart showing our average bull market. Average duration of bull markets have lasted a little bit more than 5 years. Right now, we're in the last of the third year in our current bull market, but we think that this bull market might not be average. It might be very strong based on earnings and some of the other things that I've shown you already. Okay, so earnings again are the key driver. 20% earnings is rare outside of a recession. You'll see that in these charts here, coming out of the recession in 06, 07, there we go, up 20%. So 20% earnings outside of a recession is very rare, and that's where we're at right now. In fact, this is the first time that all 11 sectors are expected to post positive earnings per share growth since 2018. Okay, so almost 10 years ago, all 11 sectors expected to post positive growth earnings. One of the things that gets me a little bit nervous in a market like this, though, is that then people start thinking it's easy, or they start second guessing. Why were we in this sector that only, grew 4% when we should have been in this sector that grew 6%? So I want to make sure that you guys understand that even within these sectors, even if the sectors post positive earnings, you still want to make sure that you're in the best quality investments in those and that you still stay diversified across all the sectors. Okay. But the market overall looks very strong. This chart on the right it says nearly the strongest upward revision of earnings over the last 20 years. So again, earnings are strong. They're getting revised higher. All 11 sectors expected to post positive earnings growth. It's a very strong market. When markets are this hot, sometimes you get a lot of novices entering the market because they think it's easy. And those novices, at the first sign of any twitches or downturns, will pull their money out, which also can trigger a short-term downturn. So remember, downturns of 5%, or even 7, 8, 10% are not abnormal in even a strong market. I just want to reiterate that even though the economy is good, it does not mean the market goes straight up like an escalator at the mall. All right. So the optimistic longer term, why are we optimistic longer term? All the good things on the back: earnings, economy, history, sentiment, the different sectors of the economy, corporate activity, bond issuance growing. So what's kind of our red light, if there was any red light? And it's possibly valuations. The earnings are very strong to support the valuations, so they're not overstretched yet. But if there was any kind of little flashing light, it might be valuations. Okay, so where we think by the end of this year, base case 8,200 on the S&P 500, could be even a little bit higher. Very small possibility of a bear market. There's always a possibility of a bear market. There's always potential for black swan events, things that come out of the blue that nobody is looking for. And COVID was a great example of that one. Okay, let's look at the equity sectors now. Okay, so actually we're still on growth. Okay, I'm going to finish that because I think I've talked enough about that one. Okay, so mega cap sector, the technology sector. Again, this is mega cap tech valuations. This is showing is that valuations actually are at a very good valuation. It compares it back to 2015. Okay, so is today a redo of the dot-com bubble? We do not think so. So let me show you this middle slide here. I like this middle slide. What it's showing is it's overlaying 2022 to 2026 in the dark blue versus 1995 to 1999 in the light blue. Okay, so if you're following me, you'll see that the earnings or the market that's the NASDAQ, the market's kind of going hand in hand. So that gives people the pause to say, are we now in another, tracking a dot-com bubble? But we don't think so. There's a few reasons. Again, valuations are still very low, where if you remember in the dot-com era, valuations did not matter. What mattered is a company had .com anything after their name and people wanted to buy it. So people were buying companies regardless of earnings, regardless of valuations. And we think that valuations are very much in line with the earnings. So earnings are a lot stronger. Valuations are more in line to not track along the dot-com bubble. But also remember that especially the tech sector is a lot more volatile than the normal S&P overall. So on the left-hand chart, we have 6 10% or greater pullbacks for the tech sector during this last 4 years, and only 10% pullbacks for the general S&P 500. So again, as a retiree, as maybe somebody that is relying on their portfolio for income, volatility is not your friend, and the tech sector is more than 3 times as volatile as the S&P 500. Because it is a little bit more volatile, though, there's some people that say, I don't want tech in my portfolio, not our clients, but there's people out there, and they're missing out on a very substantial part of the market. So tech is not going anywhere. It's here to stay, but just understand its role, and it is a little bit more volatile than the S&P market overall. So these are the key differences between the now and the dot-com earnings. I talked about that, valuations. The economy is not overheating, and speculation is not rampant. That's actually a big one too. Okay, so let's go on. Our key sectors that we like. So technology was the first one. Industrials is the second one that we really like. Okay, so data centers are a key focus of investment. They are needed for the US to maintain AI superiority. So these light blue dots, this is where data centers are currently operating. And if we overlay that with this slide, that is the planned data center offerings. So you can see a lot more concentrated on the East Coast, where there's, I think, more water available, but all over. So the build out of AI infrastructure is massive, and that's one of the reasons we favor industrials. Also, there's going to be power that's needed to run these data centers. Power needs are estimated to increase by 8-fold. Where we get this power, that is still to be seen from a lot of people. But again, I believe in American ingenuity, American entrepreneurs, and because the need is so great by these companies, we will find the power to run these. Okay, so industrials. How do we look at industrials? In an improving ISM market, which we talked about earlier, tech and industrials are two of the sectors that outperform. Okay, so we definitely like industrials. We also think there's going to be a lot of defense modernization and defense spending that is needed, and there's some headlines there to take you through that. So we think we are in the early stages of a U.S. manufacturing renaissance. So we want to make sure that everybody has the appropriate amount of technology in their portfolio, and everybody has the appropriate amount of industrials in their portfolio. Okay, so that's 2 of the 4 of our favorite sectors. Our 2 other sectors that we really like are healthcare and consumer discretionary. So let's take a look at those. Okay, consumer discretionary. Consumer discretionary hasn't performed as well year to date as we would have liked. It's still one of our favorite sectors. Basically, as the labor market still stays low, or the unemployment market still stays low, labor is strong, people are spending, restaurants are being booked. We think that this sector will definitely catch up. So it's at a very attractive valuation. We haven't seen valuations in consumer discretionary since 2010. So we do want to make sure that we have that in our portfolio as well. The other one that we really like right now is healthcare. And I love this chart that I'm going to bring up, because what this chart is showing, and I'm going to keep it really basic, but on the left up and down axis is showing earnings per share, earnings. So we're just going to simplify it with earnings. And then on the bottom going out, we're just going to simplify it to risk. Okay. So if we look at this chart that way, then ideally we want the highest returns with the least risk. And if this was a map of the United States, just say, we would want to be in Seattle. Okay. Looking at this, we see information technology has the highest earnings, but it's the furthest out. It also has the highest risk. That's what I just said a couple slides ago. But let's look at healthcare. Healthcare actually is the second highest earnings on there, with very low beta, very low risk. So healthcare, the future of healthcare, again, this is not a 3-month purchase or even a 6-month purchase. This is a long-term bull market, long-term value in the market. Healthcare is a very strong place to be. So companies are revolutionizing weight loss, joint replacements, AI technology in surgeries, discovery analysis of diseases earlier. So there's just going to be a whole revolution in healthcare that we really like. So those are our 4 favorite sectors that we like. Okay. A little bit about small caps. Small caps have had a very strong year. They're up 11% year to date. Small caps in a portfolio are some of the most volatile investments. They can go up or down, but they can drop by 40, 50, even 60% in a year. So they've had a very strong year. It's the largest, widest margin since 2003 over large caps. So sometimes what that causes people to say like, oh, we should get some small caps, we should get some small caps. So think of it just like the cherry on the top of your sundae. We want it possibly have some depending on your goals, your needs, your risk tolerance, but it should be in proportion. The thing about the small caps that still kind of worry me and also Larry Adams is that the earnings aren't really there to support that valuation. So actually negative earners, the prices of those negative earners have gone up by almost 50%. That's a little bit more reminiscent of the dot-com bubble. People are investing in potential versus actual. Maybe those companies will eventually get strong earnings, but right now they don't have them. So that's my thought. Just be a little cautious with small caps. Again, having them in proportion is not a bad thing, but too much, especially if they don't have the earnings to support it, can leave you disappointed. Okay, so we still like large caps. I'm just going to move on. There's a lot of graphs here. Okay, we're going to go to international. Okay, so again, US is the dominant area in the globe. Like WWE wrestlers, strength and durability have been key themes of the US. So here's the strength, durability, innovation. Here is the chart of the S&P 500, the stocks, Europe and Japan since 2006. And there's no doubt that over the last 20 years, that the US has just dominated. In fact, over the last decade, we have kept purposely low international portfolios, international in people's portfolios, mainly for diversification, but it just wasn't doing as much as the US markets were. We do think that's changing a little bit. We're not saying that the US is not going to remain dominant, but we do think that the Europe and especially Japan actually have some very good things ahead of them. And that overall the world will be investing in defense and infrastructure and AI, and so that we don't want to limit ourselves just to the US. But the US is still very strong, and that's been the past. So again, when we invest, this is what I always tell people, we don't want to invest only looking in the rearview mirror. We want to invest looking in through the windshield. So past earnings have been very strong. We think the US will continue to dominate, but we also think Europe should actually be doing and Japan should be doing pretty good. The one chart column I like to point out here, though, is dividend and buybacks. One of the things about Europe right now is Europe has almost double the dividend that the US does, closer to 4% instead of just under 2%. So for somebody that's wanting some current income that can actually help offset some volatility potentially in the future, dividends are very strong. And company buybacks. Some people demonize companies that buy back their stocks, but actually we're in favor of companies that have the free cash flow and that believe in their company and buy back their own stock. So when corporate buybacks are strong, to us, that's a good sign of strength of the company that we're investing in. Okay, so the US dwarfs the vast majority of the rest of the world in terms of market cap. So this is market cap as of 2010. And again, remember, we've just said that the US has dominated in the last decade. And if we look to today, currently, we're at 79 trillion in market cap. The rest of the world is 86. When you take out just Japan, because Japan is very strong. So the rest of the world, ex-Japan, is 77 trillion. Basically, the US market is stronger than most of the rest of the world. But again, that does not mean that we ignore the rest of the world, because there are still very good companies in technology and very good companies in healthcare that exist outside of the US that we want to make sure we're getting as a part of the portfolio. But the US dominance we still see going very strong. Okay, we're going to go to asset allocation now. And again, not a WWE fan. Some of you that are may know some of these names. I think I recognized Hulk Hogan, but he's been around 34 years, so a long time. I don't know the other ones. But basically what this chart is just kind of going through is what makes a winner? What makes a winner? Is a winner somebody that wins 100% of the time? And the answer is no. And especially if somebody won 100% of the time, they wouldn't be very fun to watch because you just know they would win. So what we find on average is a good winner in the WWE world is somebody that wins about 75% of the time. Okay. So that is actually in line with how the market returns. The market has 78% of the years dating back to 1940, 78% of the years were positive. The rest were negative. So if you compare the market to the WWE, I'd say the market was a winner. In fact, I like to compare the market. I use the analogy always of playing blackjack. I'm a numbers person. Blackjack's a numbers game. So if I told you we're going to go to Vegas and we're going to play blackjack, and out of every 10 hands that we play, we're going to win 8. I'm going to round up a little bit. We're going to win 8. When we win $22. When we lose $12. So think about that. We win 8 out of 10 times. We win $22. We lose $12. How long are we going to sit there at the table and play? As long as I can. And that's what the stock market is. The stock market is not an investment or not a vehicle that just goes straight up. It goes up and down. But remember, it's also companies, innovation, technology, AI, and generally over time. Okay. So again, like wrestling, there's always drama and there's always some event. And it looks like my internet might be going off, so I might freeze. Hopefully I don't. But there's always some event that's going on, wars, oil shocks, financial crises, a dot-com bubble, another financial crisis, a pandemic, always drama in financial markets, but the most important thing is to stay invested. And if those that have stayed invested get rewarded, the average annual since 1940, so a long time, for the S&P 500 is a little bit more than 11%. And the average bond return over that same time period on a 5-year treasury is a little bit more than 4%. Not a bad outcome. Okay, so oops, go back. There we go. This is my favorite slide. I've said this at the 2 events that we had in person yesterday. I love this belt, big old asset allocation in the middle. So how do we become an asset allocation champion? We understand a few things, and that's one of the reasons why I like doing these webinars and in person and via Zoom. We understand compounding, how compounding works for you. We understand risk and how much risk is appropriate for us to take. We understand diversification. And most importantly, we understand rebalancing. Rebalancing is one of the keys to successful investing over time, not timing the market, rebalancing. Discipline, staying invested through market downturns. Patience, understanding that investments take time to cook, just like a cake doesn't cook in 5 minutes. Markets need time. Having a strategy, having a long-term mindset. But most importantly, I like what's on the outside of the belts. And on the left-hand side, we have the bull and it says, stay invested, stay the course. And then on the right-hand side, it says, control what you can. And I like that because there's a lot of things that are going on right now in the world that we cannot control. We cannot control the midterms or the outcome of the midterms, except with our one vote. We cannot control what the Fed's going to do. We cannot control what the media is saying, but what we can control is our consumption of the media. We can control our emotions and our reactions to these events. We can control the quality of our investments, and we can control, if needed, generally to some degree, our spending out there. So that's our financial market belt. Okay, so I'm going to go through a few other things really quickly. That's the end of our seminar right now. Overall, a rosy outlook, but I always say rosy outlooks, take them with a word of caution, but overall, a very strong outlook for the markets. I also wanted to remind people about something called our 20-minute Ask Anything, and this is for clients only, for their kids, grandkids, nieces, nephews, anybody that's important to them. And the way I look at it, it's really set up for somebody that's maybe younger. Maybe they've got their first job, they've got a 401k, they don't know what to invest in. Maybe they got a small inheritance from an aunt or an uncle, or maybe they're getting married and they just need a little bit of advice as to how to handle some finances. We do a 20-minute Ask Anything. We don't charge. and we will help your child or grandchild with whatever financial issues are on their mind. They do not become clients. We just kind of give them some guidance and send them on their way. But we also do a second opinion service, and that is for somebody that might have more complex financial needs. And you don't need to know what those needs are. Sometimes people say, well, I don't know what my friend has or doesn't have, and that's okay. That's not the important thing. The important thing is if they look like they're looking for somebody to help them either get ready for a major milestone event, retirement, or they've experienced a major milestone that's not so good, like the death of a spouse or a divorce, and they just want a second opinion to see where they're at. That is something that we will always do. If they are right for us, we will explain how it works to become a client. If they're not a right fit for us, then we will help them figure out what's the most important thing for them to do. So always remember, we have the second opinion and the 20-minute Ask Anythings. We also have our coffee clubs the last Friday of every month. So if you're in town, you can come to those. We also have them via Zoom. We also have, Carrie is going to be doing an Understanding Social Security webinar. That is a very good webinar. Some of you guys, I know you're like, I'm already on Social Security. That's fine. But the choice of when to take Social Security is one of the biggest choices that you will make in a lifetime. So if you know somebody who's in that age range, 60 to 65, and they're trying to figure out, should I take it at 62? Should I take it at full retirement age or wait till 70? Have them tune into this webinar. We've got a guest speaker on there who's a Social Security specialist along with Carrie. It's going to be a great afternoon. Also, we're doing a school supply drive trying to help the local schools and teachers. So if you want to stop by on August 7th and drop off some school supplies, Tammy has the list of things that are needed. And for fun, just for fun, we've got a small group, probably about 15 ladies that come and do mahjongs once a month. So these are our mahjong dates. If you don't know how to play, we will teach you. If you know how to play, come on and attend. There's no cost to attend. We just bring a snack to share and we'll have beverages. So the last thing is I'm going to go through all our disclosures here. The opinions are of myself and not necessarily of Raymond James. And then there's just other disclosures here that we're going to go through. And with that, that is the end of our webinar. I hope you guys enjoyed it. Please feel free to send along any feedback that you have. And as always, if anything that we mentioned strikes you and you want to discuss with us, just reach out to us. No problem. We can set that up for you guys. Okay, with that, I'm going to say goodbye to everyone.